Hello and welcome back to another session, Loan Origination within Mortgage Production module. So basically the loan origination is a process of originating a mortgage. So what are the different processes which are involved in loan origination? There are client prospecting, pre-qualification, initial disclosures, and the rate locking. These are the four things which are going to happen in loan origination. Let's learn about what is client prospecting. So the primary activity in the client prospecting is basically generating the leads for the new loans. There are various channels of the mortgage lead generation and or origination. Broadly, the channels can be classified into two types, the retail and the wholesale. So as you can see in this infographics, the retail channel. So when a borrower comes in direct contact with a lender, so he's not going through any broker or he's not going through any other person, he's directly approaching the lender, and that origination channel is said to be retail channel. So some of the various forms of the retail channel are the bank branches. The borrower can directly go to the bank branches, existing customers of the banks and the lender. If I'm an existing borrower in that particular bank, if I'm referring someone, then that channel is called as retail channel. Call center, somebody calling the call center to know about what are the different mortgages are available in the bank. Loan consultants and lender websites. These are basically the retail channels. Wholesale channel. What is wholesale channel? So vast chunk of the loan originations basically happens through the indirect channels where the lender is not contacted directly by the borrowers. So there are intermediaries involved who do most of the origination activities and may also be able to do some part of the processing as well. So what are those different channels and what are those intermediaries who are basically involved in the wholesale channel? First one is the broker. So brokers are independent bodies who act on behalf of the lender. Unlike a loan consultant who represents only one lender, a broker typically is an agent for the multiple lenders. He will not only represent only one lender, he would be having contact with the multiple lenders. He tries to pre-qualify the borrower credentials with the multiple lenders to get the best possible pricing scenario for the borrower. Basically, he would shop different lenders on behalf of the borrower. They may also adjust the pricing by charging points which can be paid to them and not the lender. The flexibility that these borrowers have to offer makes them so popular mode of loan originations. The brokers may or may not be able to also do some part of the processing of the loan for the lender. The loans originated by them are closed in the name of the lender itself, not in the name of the broker. What are the other channels in the wholesale? Correspondents. Correspondents are the banks or the financial institutions that have the capability to originate and fund the loan on their own. So these guys are able to even fund the loan also. So correspondents can act as the brokers where not funding themselves, or mortgage lenders when they do fund and close the loan in their name basically. So the mortgage lenders forge. So the mortgage lenders forge tie-ups with the local financial bodies thrifts, credit unions, local banks, and other financial institutions, so that they can increase the reach and also save an origination cost by not having to maintain the dedicated sales infrastructure. All right, so what all the different type of processes involved in terms of loan origination? First one is pre-qualification. So in the pre-qualification stage, the borrower is required to provide the basic minimum details about his financial strength and the type and value of the loan he is interested in. These details are underwritten against the lender standards and calculations are made to evaluate the lender's eligibility for the loan. In case he is eligible, the best possible loan scenarios are presented to him for him to choose. This whole process is called as a pre-qualification. So basically, the pre-qualification helps to ensure that the borrower is serious for the loan, and also make sure on a broad level that at a broad level that the borrower has the capacity to pay back the loan, like in terms of installments. If all goes well within the pre-qualification process, you will receive a pre-qualification approval letter telling him, like him or her, home sellers, that you qualify for a certain mortgage amount, because it demonstrates to the seller that you are a serious buyer, basically. So if a borrower is approaching a seller of the property and doing the pre-qualification, it depends on what level of information the borrower is ready to provide it to the lender for the pre-qualification process, so that it makes sure borrower is really serious about buying a property. So and also the scenarios which are contain values of the parameters, so when doing the pre-qualification, you would come to know what type of mortgage is required and what is the purpose of the loan, whether it's for purchasing the new property where the borrower is going to be occupied, or whether he is having his vacation home. So that kind of the analysis is done, which is done in the loan purpose, purchase price, what is the price of the property, loan amount, interest rate, what interest rate the loan might have to have, discount points, which are basically credit points, which are offered by the correspondents or lender to the borrower. Origination fee, annual percentage rate, APR, what is the APR for the entire year, and loan term, how many years the loan tenure has to be, initial principal and interest payment, minimum down payment, what is the down payment that the borrower is making, maximum secondary financing, private mortgage insurance, whether it's required or not. So if the LTV is more than 80%, then you would have to look for the lender has to look for the PMI. Escrow impound account required. So if the principal, insurance, tax, principal, interest, tax and insurance, this tax and insurance will go to the escrow account. So whether that account is really required or not. A prepayment penalty clause is required or not. Some of the loans, they do have prepayment penalty. Say for example, if you want to pay off your loan, then if you do the payoff, then you will have to pay some certain amount of penalty, since a bank is going to lose certain revenue. And prepayment fee term. Prepayment fee term is something like, what are the different type of, what are the different terms and conditions are associated with the prepayment fee. So these are the things which are going to be discussed in the pre-qualification process. So next one is rate locking. A borrower is given some loan scenarios after initial pricing based on his credentials. He can choose one out of them. So borrower has a option, is given with the multiple options. His loan can be processed for his chosen scenario. A typical loan may take up to 30 to 60 days to be funded. The lender carries a risk of the interest rate fluctuation in this period. This may induce the initial pricing conditions to change as per the market changes. If the lender wishes to pass on the impact to change to the borrower, so the lender carries a risk of the interest rates of fluctuation in this period. This may induce initial pricing conditions to change as per the market changes. So if the lender wishes to pass on the impact of changes to the borrower, so the borrower may end up with a different loan agreement altogether. To avoid such kind of uncertainties, the borrower is required to lock the rate at which he wants his loan to be processed by choosing the best possible scenario. This process is called as rate locking. The borrower may have to pay some amount for the rate lock, which later is also adjusted with his closing fees when the loan gets closed. Within 3 business days of the rate locking, the lender is required by law to send electronically or via the mail a good faith estimate of the closing cost you will pay. So this is one of the important, the federal law, which says within the 3 days of rate locking, the borrower should receive the good faith estimate of the closing cost. So the lender also are required to give you the government publication, a home buyer's guide to settlement cost, a detailed discussion of the home buying process and the closing cost, and the truth in lending disclosure, a document that discloses important terms of your loan. All right, so next thing is initial disclosures. So before proceeding with the loan processing, the lenders are required to apprise the borrower about the complete details of the loan and also about all the changes associated with loan production, including all the third-party charges. These charges may not be exactly true, but should be based on the honest judgment of the lender. This stuff is called initial disclosures and is a legally binding activity for the lender. Disclosures are provided to comply with the following regulations. First one is good faith estimate of settlement cost, GFE. The lender or the mortgage broker must provide a good faith estimate of settlement service charges that is likely to be paid by the borrower. Servicing disclosure statement. The lender or the mortgage broker must inform the borrower in writing when the loan is applied or within the next 3 business days, whether it expects that someone else will be servicing the loan, whether this particular loan servicing rights will be transferred to some other person or it is going to be kept with the loan originator itself. Those things are going to be provided by the lender to the borrower. So the Consumer Financial Protection Bureau, CFPB, recently issued a new mortgage disclosure rule that combines the mortgage disclosure established by the Truth in Lending Act, which is called as TILA, and the Real Estate Settlement Procedure Act, which was called as RESPA, into a single rule known as the TILA-RESPA Integrated Disclosure, which is called as TREAT Rule. The TREAT Rule has been in effect since October 3, 2015. So the goal of the TREAT Rule is to promote clarity during the loan process by providing borrowers with accurate and consistent information in connection with the different loan and settlement cost options offered by their lenders. The TREAT Rule applies to most closed-end consumer credit transactions secured by the real property. For example, all lenders making mortgage loans, including the community banks, but does not apply to chattel dwelling loans. For example, loans secured by a mobile home or by a dwelling not attached to a real property. So the TREAT Rule has placed the 4 disclosure forms previously used under TILA and RESPA with the 2 new integrated forms, a loan estimate, that is LE, and the closing disclosure, CD. So here are some of the new the details of these new forms. First one is the LE, which is loan estimate, issued by the lender, contains the loan amount, loan term, interest rate, and the monthly payment, and states whether any of these can change and whether a prepayment penalty or a balloon payment is applicable to the loan. Additionally, the total closing cost, for example, the lender originates the fees, taxes, government taxes or government fees, any deposits, and the down payments and the seller credits are specified to reflect the amount of money due at the closing. This loan estimate and the closing disclosure are very important as far as revealing what are the different prices and what are the different costs associated with the loan which borrower is going to be provided. Other than reasonable credit report fee, lenders cannot charge any fees until the loan estimate has been provided to the borrower who has been advised that application can be processed. The closing disclosure is issued by the lender or its settlement agent, reiterates the LE information, that is loan estimate information, and specifies settlement cost. For example, the closing disclosure contains a table comparing the estimated closing cost on the loan estimate to the final cost contained in the closing disclosure. So this allows the borrower to review the fees, terms and any of the changes, and to question the lender about them. The CD, the closing disclosure, must be provided to the borrower at least 3 business days prior to the closing. Certain changes such as annual percentage rate, increase of more than 1/8 of a percentage point for a fixed rate loans, or 1/4 of a point for the adjustable loans will trigger a new CD form to be prepared a new 3-day waiting period to begin prior to closing. If there are any changes in the terms which are mentioned in the closing cost, then they will have to prepare a new closing disclosure. So the TRID rule provides that the borrower can waive the 7 business day waiting period after receiving the loan estimate and the 3-day waiting period for after receiving the closing disclosure if the borrower has a bona fide personal financial emergency which requires closing the transaction before the end of the waiting periods. While this term is not defined, the CFPB's example sets a higher bar as it involves a borrower facing an imminent foreclosure sale of his or her home unless loan proceeds are available to the borrower during the respective waiting periods. Having said that, this is all about the loan origination. I hope you enjoyed this course. Thank you for listening. I will see you in the next chapter.